Hi everybody, this is Thomas Wynn from Wynn Capital with the 2024 fourth quarter market summary. On the screen is all my contact information, so connect anytime if you have questions or comments. Before we get to the slides, let's take a look at the graph of the S&P 500 for the past 3 years to give us some context on where we are. Okay, I know this slide is a little bit busy, but it's basically going back to the end of 2022. 2023 was an up year. In the fourth quarter, there was a decline, and I'm looking at what we call in technical analysis a channel. There's been a very orderly rise in the market until this week. Today, actually, the market made a new all-time high today, earlier in the day. And from that low, we've only had a 6% decline, on this date, which like April 15th. Then we had about a 9% decline, a couple of tiny declines, then the most recent 5% decline after the election. This week was the election. Trump won, the market rallied, we went sideways and then retraced all the way back to where the election was held. And now we've had 2 weeks of rising prices to get back to new all-time highs. Okay, now let's dive into the quarterly returns and we'll get into the full year returns. On the screen is a summary of asset classes, the US, international, global, real estate, and the bond market. And there was actually a gain in the US, but there was negative returns for almost every other asset class. The cumulative fourth quarter returns for a 50-50 stock and bond portfolio, which is about where the firm is. We have clients that are very aggressive, very conservative, everything in between. If you put the whole thing together, the firm is about 50% in stocks, 50% bonds. So the benchmark for that was down about 2% as the negative returns in all these categories, especially the bond market, offset the gains in the US stock market. Cumulatively, we were flat as a firm relative to the benchmark, so we outperformed the benchmark. And you can see the best quarter and the worst quarter for each of these. I always like to point out that even though international stocks developed, underperformed the US over time, foreign emerging markets, which includes China, they're fast growing, very volatile. They have better performance over time. If we go and look at the longer term for all these periods, the 1 year returns, 5-year annualized, and annualized for 10 and 15 and 20 years, every single one except for the US bond market over the last 5 years is up. And that is a product of a 9-year rally from 2009 till the present, pretty much, with a couple of down years, but mostly up years. Now we're looking at a chart for the fourth quarter only of the prices expressed in this graph and the news that accompanied the price changes. So I called out a few things. Home sales are on track for the worst year since 1995. That's in October. And then at the end of the year, November home sales post biggest annual gains since 2021. Individual statistics are volatile, is what that's telling us. The bigger news, of course, was Trump won the election, and there's going to be 4 years of a new administration, new policies. I don't have an opinion on the direction of the market. There are many factors that will affect that other than the policies of the US president, but I do expect increased volatility. And for, in general, clients that have aggressive portfolios, we're hedging right now all the way until September. Bitcoin passed $100,000. Now, we don't directly own Bitcoin, but we own Coinbase and many of the other exchanges that are listed companies and all the companies that provide services to the Bitcoin universe. So we are indirectly profiting when Bitcoin goes up, and Bitcoin has a significant effect on the market. This is the same type of chart except for the full year, the past 12 months, from the beginning of the year to the end, our prices reflected in the graph. What was really interesting about the year was that the Fed started to talk about lowering interest rates, and they eventually did start lowering interest rates. and that had a positive effect on the market overall. Now we're going to look at all the different types of stock classes, US, foreign, and emerging markets. And the US had the best performance, large growth. All the big tech stocks, as usual, were leading. Small value was trailing. And I called out the 15 years since 2009. We've had tremendous performance in that, which is what turns all of these positive. Most times when you look at 20-year annualized returns, you've got some bad periods in there. But after almost 10 years of very, very strong equity growth, we've got positive returns all the way across the board. And for the US, it's been incredibly strong. Now we've got international. International for the fourth quarter was negative, and for longer periods is positive, but trailing the US by a huge margin. Even though we're looking at a period of US outperformance, when you go back in time during the lost decade from the tech bubble crash of 2000, 2001 until 2009, when the market started to recover, relative to foreign, the US underperformed. And if you look back in time, there's long periods. These are very unpredictable. Whenever we have a graph that shows what happened, it makes us feel like we could, based on this graph, we could figure out when that happens, but we can't. People try. There's data that shows people have tried to time this by concentrating in US and switching over to foreign. They've never been very good at it. We're in a long period of US outperformance, and we are globally diversified, and over time, over long periods of time, over most people's investment time horizon, owning foreign has led to better returns over time. Global diversification beats it. There was massive underperformance, in fact, negative returns for the US during this time, positive returns in foreign, and that smoothed things out for globally diversified investors. Now we're going back to emerging markets. This is a small percent of the global market. These include China, though, so a big economy, but still considered an emerging market and not all the way developed. And negative returns in that area as well. And longer term positive, but trailing the US by a long shot. This will reverse sometime. I don't know when, of course, but at some point, global diversification will pay off. Now we're looking at country returns, and you can see most countries had negative returns. Some had extremely negative returns for the quarter. This was the average globally. The US was slightly positive, and that was the quarter in general for the countries. Real estate, which had negative returns for quite a long time while rates were rising, had positive returns, at least in the US, for as interest rates started to decline. And the Fed is still lowering rates. They've lowered rates 3 times, but mortgages and long-term bonds and other rates are rising. Most people think that the policies that Trump is talking about, deporting people, tariffs, and lower taxes, are all inflationary, and so real rates, including mortgage rates, have gone from 6 to 7% again, and real estate has therefore had a difficult quarter. It's important to know that we use 2 REITs. REITs are in our diversified portfolios, but 2 single REITs we use had positive returns, as they usually do each quarter and each year. Now we're looking at commodities, and again, extremely volatile as usual, with sugar the worst performing and coffee the best performing. I don't understand why they're not correlated. I usually have sugar in my coffee. But I've highlighted what was up, and what was up was energy, and almost everything else was down. On the screen now is DFA's little editorial, and it's got the same message as almost every editorial has, which is they're talking about a single indicator, the University of Michigan consumer sentiment, and basically they're saying there's no correlation to this indicator coming out as almost every, in fact, every indicator that comes out is one of thousands and thousands of things that make the market go up or down. Almost all of them are very, very unpredictable. So there's ways to profit and do well in the market, and it's basically globally diversified portfolios, very low fees, and understanding taxes, and especially making sure that your portfolio has the right risk so that you don't panic when we have periods of declining prices. That is it for now, everybody. I hope you found this helpful. And if you have any questions, you can connect with me anytime. Thanks a lot. Bye-bye.